The exchange traded fund, the ETF is way better because it's a basket of stocks and trade like a stock. So like I'll use an example. If you go to Walmart and go into the oatmeal aisle, you have the strawberry box, the bananas and cream, the regular, the cinnamon and apples flavor. Well, they have a box called the variety pack that has 2 packs of banana, 2 packs of blueberry, 2 packs of strawberry, 2 packs of peaches and cream, and that would be an ETF. So for the oatmeal box, if a flavor you don't like, say the pizza and cream, you don't like it, you have other flavors to eat. The same thing applies with dividend investing in ETF. I'm not giving no any financial advice in the video, by the way, but it'd be the same concept. ETF is a little bit safer than a single stock. If ARR decided to cut the dividend, or Horizon or Management Capital, that's a single hit. But the QLD, and it has other ETFs down below, is a safer bet. Overall, a safer bet because they have a basket of stocks inside, and one or two takes a hit. Most times, whoever runs that, whoever owns that fund will place those two companies with a different company, and so forth. But yeah, better surroundings. And then starting off, with Acorns for matter of fact, a lot of people start with Acorns, then go to Robinhood. That what happened with me. I had Acorns, and I saw I got a dividend payment, and with the dividend, Acorns mainly invest in ETFs, so it's a safer bet. Again, I'm not giving financial advice in the stock market. Make sure you do your own research, but typically an ETF is much safer than a stock. And anybody starting out, I will go the ETF route because it's easy to understand. It's a little bit safer. It has a top, like QLD has the top 10 companies in the world, like Tesla, Microsoft. You might have Walmart. You might have whatever, Merck, whatever. So you have different types of companies in one fund that supports that fund. But the single stock is great too. Well, great track record. But again, if that company takes a hit, like we saw in March 2020, it can be devastating. So if you look at Acorns, they mostly, I think all of it, invest in ETFs. And that what broke down what ETF is and how you want more risk. You spread out your risk with ETF. With a single stock, you're not. But I like both. If you're a dividend investor like me, you invest in companies, ETFs that are safe and it pays a dividend. And just the companies that I invested in consistently pay a dividend monthly, so I keep sticking with them. But also with these single stocks, company stocks, have a cutoff limit. Now, how long are you going to invest in a company? You should diversify your portfolio as well. Not always have a basket of stocks and a basket of ETFs. You want to balance them out in different sectors. Maybe some real estate, some financials, some companies do debt, make loans. You have some tech stocks. They have some health stocks. They have some ETFs. So you want to diversify what you can, and that's the main goal of the video. Which is better? ETFs are better. They're much better, but they're more expensive. Not expensive, but they cost more. Like, it's hard to find an ETF that pays $5. That the price is like $5 or $10. AR is $11 a share. It's hard to find an ETF. And then if the ETF is that small and they pay a big dividend, you gotta watch out for that too. But ETFs are cool. I got QLD. The CLM is CRF and RIV. They're funds. And YYY. Newsy is a really good one, but Newsy is like $28, $29 a share. JetP is pretty good too, but that's like $45 a share. RIV and CRF, those are you can no longer buy those in Robinhood, but they're pretty good. But they pay a really high dividend. Like, there was paying like 19 cents a share, and they pay like 16 cents. So it's nothing long term for that. It's hard to say with those, but I would definitely look at ETFs. YYY is a pretty good one. I paid 12 cents per month. I hate the browser of Robinhood, but ETFs typically cost a little bit more than a single company stock. And then if you pay a $10 for ETF, how much are you paying in dividends as well? Because if they're paying 10 cent, like you gotta be worried at. So how much? Because it was CLF, they paying 60 cents a share. That's still kind of high for a $10 stock ETF. So you gotta watch what you buy, and you have to try it out for yourself. You have to try it out for yourself and do your own research to see which is better. I can say 70% of my portfolio is into like single companies, and 30% is in ETFs. I want to get to 60-40, 60% company and 4% ETFs. And I'm working on that, but ETFs does cost a little bit more money overall. They cost a little more money. But yeah, that's all for the video. Please subscribe to the channel, like the video, share the video, and I'll see you next time.